Well, good morning, everyone. It's 10 o'clock, so we will call the August 10th, 2023 meeting of the Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of July 13th, 2023. Have a motion and a second. Please record your vote. Item is approved. Item number 3 is a presentation by Lazard Asset Management. Jason, you want to give us a little introduction?
Just before we get started, thought it would be timely just to have Lazard come in and give an update. We haven't had managers in for a while, no particular issues, but Lazard is one of 2 international development managers that you have in your portfolio. I'm sure Mike and Ben will get into performance and market commentary, but it may be surprising to all of us that the EFI, or International Developed Markets, is the best performing broad asset class in the last year, even outperforming the S&P 500 through yesterday by about 4%. Similar to what we're seeing in the US, larger cap names have dominated and growth has outperformed. As we look at your performance, and I'll go into this a little bit afterward, we're a little bit behind our EFI benchmark because you're doing some different things. And Lazard as well, they have some ability to go into emerging markets, market cap a little lower than the EFI benchmark, same as we see with your other manager, Harding Loevner, which is a little bit more growth oriented. They're adding a lot more emerging market exposure, about 25% opportunistically. So there is some deviation there, but I'll let them get into the detail. Again, they're one of 2 developed market managers, the more core with a slight value bias.
Good morning, everyone.
Good morning.
My name is Ben Young with Lazard Asset Management. It's a pleasure to be here. It's my first time here, so it's very nice to meet all of you. Appreciate the opportunity to talk about our portfolio just a little bit, provide a bit of an update here. I know the relationship's been a little over 10 years, so definitely appreciate the continued confidence with your investment with us. Just by way of quick introduction, I'm responsible at Lazard for client service and business development for institutional relationships in the South. And I'm joined by Mike Powers. Mike is a portfolio manager at Lazard. I've been with the firm a little over 30 years. Joined Lazard in 1990, so a wealth of knowledge when it comes to international markets. I'll let him do most of the heavy lifting here as far as talking about performance and kind of what's been going on. But maybe just quickly before handing over to him, just a very quick reminder on the portfolio, kind of how we put some of the pieces together and kind of what we've been seeing recently. As Jason mentioned, our portfolio does fit a little bit more on the value side. We use what's referred to as a bottom-up relative value investment philosophy. What we mean by that is we're looking to identify companies on an individual stock-by-stock basis on their individual characteristics rather than a top-down macro view on a particular sector or a particular country. So rather than making a call on, we like an overweight to this country or this particular sector, all of our overweights or underweights are residual of that bottom-up process. I mentioned relative value. What that means to us is we're looking to identify companies that have a very attractive trade-off between financial productivity and the valuation and the price we're willing to pay for that. So think things like high return on equity, high free cash flow, very strong balance sheets, very strong pricing power in the face of inflation, things of that nature, and then recognizing there is a bit of a trade-off for sometimes what we're willing to pay for those characteristics. In the face of a recent market environment, maybe a period of COVID, some of those things like profitability and maybe I guess I'll say fundamentals have somewhat been a little bit out of favor. And I'll let Mike kind of talk a little bit about that. And we've seen some extremes during COVID, say 2021, 2022 environment of what has been in favor and kind of the extremes of whether it's style or what the market seems to be recognizing and rewarding rather. And what we've seen year to date and over the past couple of quarters, we've seen that start to subside a little bit. We're encouraged maybe about the current environment and kind of the way our portfolio is currently positioned for this current environment. And maybe I'll let Mike talk a little bit about kind of what we're seeing in some of the performance as well.
Good morning. I think, Regina, you're going to do some slide advancing. And so, and just for the timing, if we finish up by the 10:30-ish, including questions, is that what's on target? Okay. So, yeah, I'll pick up the narrative on sort of economic market backdrop, then get into how we've performed. We can talk topically about what's in the portfolio, what's helped, what's hurt, and some outlook. Is that, if we do all that in, say, the next 25 minutes, we're doing all right. Okay, so in terms of economic market backdrop, that's page 16. Let's see if we match up. There we go. Okay. So I think the things that I would highlight are that, and maybe Ben has talked about this a little bit already, but and Jason as well, that the environment has improved and I think is still improving, both in terms of making positive and attractive absolute returns, and also for us to outperform. And I'll elaborate on both those things as we go here. And I think that improvement is that as a result of the virus and all the stimulus, monetary and fiscal, that central banks and governments took around the world during the virus, appropriately to fight off the negative effects of the virus and the lockdown and the unemployment and so forth. The outcome of that was obviously inflation, as we all know. We've all been living through it. And in this country, just to use that as an, sort of an example and a bellwether for what happened around the rest of the world, our inflation peaked at about 9%. And with the most aggressive central bank tightening that's gone on since Paul Volcker back in the 80s, that started a little more than a year ago, where they went from 0 to about 5.5% on Fed funds rate. That's the steepest and most aggressive ascent, I think, ever. I think even more than Volcker did. Volcker went all the way to 20 plus, but the initial phase of that has been the steepest ever. And that can take a year to a year and a half to sort of begin to affect the economy. And the good news is that growth has been, economic growth and corporate earnings growth have been surprisingly resilient. That everybody's been saying that in the first half of this year, or even the second half of this year, you're likely to have a recession, which typically means corporate earnings fall, tough for stocks. And with that aggressive rate increase environment last year, you still had economic growth. This is 2022 I'm talking about now. You still had economic growth and corporate earnings growth, but stocks went down. They went down double digits because of the fear that that recession is coming. But it hasn't come yet. And unemployment has stayed in the mid-3s, happily, and again, indicative of what's going on around the world. And corporate earnings have been positive and often beating expectations. And so we're sitting here today with double-digit positive returns year to date. I think few would have anticipated that on January 1 of this year. I think another thing that is on the way to getting more normal is, so I think I've just explained a lot of why returns have been strongly positive this year after being negative last year. Again, the economy both years was growing and earnings were growing so far. And in terms of the aggressive stimulus, that brought some extremes in terms of both style and quality factors in investing. And by what I mean by that is that if you were a more marginally profitable business, maybe more highly indebted, lower bond rated, and maybe more cyclical, with all the stimulus that was present in the first 2+ years of the virus, our fixed income people explain it to me this way: if you could call in your bonds or call in your debt, issue new debt at a lower interest rate, you got a credit rating upgrade, your stock went up, based on all that. But that still doesn't mean you're a great company. It just means that some good things happened. This extraordinary stimulus helped you, the company, and the stock can outperform at a time. So that would explain how, excuse me, lower quality companies could have some kind of time in the sun when they would outperform. And correspondingly, at the other end of the spectrum, sometimes the most growthy companies, which, growth companies by definition are the share price, the current present value of those sort of out years of earnings and cash flows. When I say out years, I mean years 2, 3, 4, even 7 and 10, discounted back to present value. The lower interest rates go, which they did in the first couple of years of the virus, the more that flatters that price to earnings multiple and makes the stock price go up. Now with interest rates having moved up and hopefully on their way to normalizing, that effect has sort of been taken away as well. And so we tend to not do so well in either the lower quality environment or the most growthy environment. We tend to operate more in the middle, that relative value space. And our portfolio has generally the characteristics of lower indebtedness than broad market. We often grow our earnings faster than broad market. And we're, our valuations are sort of in line-ish. Sometimes they've been cheaper, sometimes a little premium, but the premium or the in-line-ish valuation we pay is more than justified, we think, by the premium return on capital that our companies are generating and or the faster than normal earnings growth that they're generating. So those factors have come together now as things are on their way to getting more normal in terms of monetary and fiscal policy. And our performance is improving, and I think that's the trend that's coming. It is here now, or I think already, and will continue to come. So Regina, on page 17, here's our performance, which is just about a 10 years worth. You can see our inception was September, over in the upper right, September 5th of 2013. I was actually standing in this room with Tony Doty. I think I was over there and Tony was over there, and here I am 10 years later. And so you'll see that second quarter, again, a nice absolute, us 3.87, index 2.95. And by the way, these are mutual fund numbers, so they're net of all costs. There's no other cost in addition to this. So 92 basis points ahead. Year to date, us at 12, index 11.67, 33 ahead. You can see that during the virus of 2020, we had a pretty good both absolute and relative year, a double-digit return, 276 basis points ahead. But then the next 2 years of 2021, 2022 were difficult, again, for those reasons I talked about, sort of this alternating sort of phases of the extreme outcomes you got, extreme market conditions that you got from all this, the history's biggest stimulus. You hear economists say that the level of stimulus was 4 or 5 times bigger than even as a percentage of GDP than what you had either during the Depression or the global financial crisis. So it's huge stimulus, brought some distortions, again, in various times helping either the lower quality or the more growthy companies do the best. And that explains, in our opinion, what happened in 2021 and 22. Again, 2023 so far showing that things are beginning to normalize in terms of stimulus, monetary policy, corporate earnings, GDP are all coming through nicely so far. And that's a much better environment for us. If I turn the page, thank you, Regina, on page 18, here's what I'm talking about in graph form. You'll see that the right of the dotted line, you see that starts to pick up that 2020, 21, 22, et cetera. And when what this line is showing is the difference between Europe, Australia, Far East, that's EFI, growth minus value, 1 year look back, when the line gets very high, as it is in sort of 20-ish, there you see that very growthy stocks are outperforming at that time. Growth is outperforming by a big margin relative to value. And then at the other end of the spectrum, and this is 2 standard deviations worth in both directions, you see that the deeper value really starts to have moments of outperformance. Again, a lot of that, I think, is driven by all the stimulus and particularly the monetary policy that was present then, which is on its way to normalizing. And we tend to do better in that shaded area when the difference between growth and value isn't that big. And so that's what's happening. That, by the way, is often what's the case in mid-economic cycle, which is most of the time. But, you know, again, in the last 3 years with the virus and all the stimulus, it was a very extreme environment in both society, the economy, and in markets. And that's, so I've tried to explain that. And again, things are on their way to becoming more normal. Any questions, comments so far? Okay. So in terms of some attribution highlights on the next page. Thanks, Regina. Here, let's look in the lower panel, which is the year-to-date. That's the 6 months of the first, you know, part of this year. And let's look at the 3 or maybe 4 biggest areas that helped us. Start with that. Information technology, you'll see, helped us 187 basis points worth. What was going on there was, remember when the virus came, everybody was, you know, locked down, working from home, and buying new phones, you know, iPads, personal computers, and so forth. Big demand for everything tech, including semiconductors. Semiconductors went into shortage, then the industry, you know, responds, and finally you get to a glut, and so that sort of inventory down cycle and demand down cycle, which I think is just sort of bottoming and beginning to show signs of ending. We thought that was and valuations were cheap in that space. We took some positions and got to be a little more than double weighted in semiconductor-related stocks. That worked out beautifully, and with the NVIDIA earnings announcements, NVIDIA is the company that designs these very advanced chips that wind up going into servers and data centers to support artificial intelligence. You know, that as everybody like, you know, Google and Microsoft are building out their capability to do that, big money being spent there, and that's really been a big stimulus for those semiconductor and semiconductor equipment companies. We had a double plus weighting, did really well there. Consumer staples was about reopening and recovery. That's food and beverage stocks. And here, you normally think of food and beverage as being probably the most defensive part of the opportunity set. No matter what the economy is doing, people tend to buy their food and drink. But actually during the virus, that wasn't true because stadiums, bars, restaurants were all closed. That's about 1/4 to 1/3 of their sales. So they weren't defensive. The earnings went down, the stocks underperformed. So actually, as you've had now this rolling sort of reopening, where remember with the vaccines and the lockdowns working, the US opened up first, followed by Europe, and only like last fourth quarter and the early part of this year was China and other parts of Asia and Japan starting to reopen. So this kind of rolling reopening that spread around the world, starting here first, that's really been good for consumer staples because the stadiums, bars, restaurants, and all reopened, and the demand came back, and the earnings came back, and these stocks have done beautifully. Our stock picks really worked out. I'll mention one more on the good side, which is industrials. Again, here, reopening, recovery, resumption of travel. Excuse me. We have a position in Europe's largest airline, Ryanair, been a home run stock. Airbus, the competitor to Boeing. Boeing's problems have been their opportunity. That's been a wonderful stock. We have some other aerospace related. We've also got sadly, some defense, you know, in the first week of the war, when that started, we took a pure defense position, a French company called Thales. That's worked out very well as there's seemingly infinite demand, unfortunately, for what they do, their defense electronics. You know, resumption of travel, reopening, recovery, and also the transition to where electricity is going to become a growing and actually at some point a majority of the energy used. We have stocks that benefit from that shift, and so that's really worked out for us. And then on the other end, the negative section, consumer discretionary, those are big ticket consumer items like autos, luxury, and our group did well, outperformed the broad market, but there was a part of the consumer discretionary group that was very expensive, and that's luxury stocks like Louis Vuitton, Hermes, Kering, which is Gucci, and I think I'm skipping one or two, Richemont, which is Cartier, and there's one or two others. Typically, those stocks have very high PEs, just like their products are very expensive. You know, 30 plus kind of PEs. We weren't positioned there. And with the China reopening, those stocks really ran, and not owning them cost us about 60 basis points. And then we had again, our group did better than broad market with a double-digit return, but that part of the index, those other ones did better still, and so we didn't fully keep up there. And so, even in spite of having a lot of good outcomes in consumer discretionary, we didn't keep up with that space because of some expensive stocks there doing quite well. So geographically, on the next page, thank you, Regina. Here, again, the lower panel, you'll see the 6 months, pretty nicely geographically diverse. We did quite well in the United Kingdom, UK. Japan did very well. That's where a lot of those sort of the equipment makers that make semiconductor manufacturing equipment, those are located in Japan. Emerging markets has been very good for us. Remember, as Jason pointed out, that's an out-of-index position, so we want to be really careful and have a high conviction to take positions there that's out of index. Asia ex-Japan, that was really about being underweight in a still struggling to reopen, but also expensive area. Middle East is we had one stock in Israel, and because of all the political turmoil that you might have been reading about there, that's hurt their currency and their market. We think we have a very quality bank that we own there, but been hurt by the sort of the general political backdrop currently. North America is Canada. That's also an out-of-index position. One stock there, Suncor, an energy company, as the price of oil has been down in the earlier part of the year, that underperformed. Continental Europe also, that's where those luxury stocks were domiciled. That was a big part of that. Again, our Continental Europe stocks had a double-digit positive return, and also, outperformed the broad market. But some of the stocks we didn't own in Europe, as some of what I've talked about, that hurt us. And maybe, let me check how the time goes. We've got about 7-8 minutes. So I'll offer now maybe something about the asset class. Jason mentioned how international has had some moments of outperformance, notably in the fourth quarter of last year and in the first quarter of this year. International and international currencies meaningfully outperformed the S&P 500. Here's some sort of backup stuff on that. On page 35, thanks, Regina. There we go. So this is a 20-year timeline where this compares that sort of blue mass that moves across the page, rising or falling, most of the time falling from that zero horizontal line. What that is that shows you in EFI, the price to earnings next 12 months. How does that compare with the price to earnings next 12 months of US? And you see that over the 20-year period, you see that average line. That average would be at about a 12% discount. But lately, it's more like a 32% discount, just to use a little bit rounded numbers and make the math easy. And so currently, you're getting about 20 percentage points of extra discount. The 12 minus the 32 gives you that 20 that I'm citing here. About 20 percentage points of extra discount or extra cheapness in non-US stocks. I would also add to that the US dollar, which rose very steadily for 10, 12 years and got to be pretty highly valued against a basket of foreign currencies or a composite of foreign currencies, that's also probably, the dollar is probably, when I ask our fixed income people, global fixed income people, how highly valued is the dollar relative to fair value, the answer that comes back is 15, 20%. So again, using rounded numbers, internationally, you probably have 20% cheap stocks in 15 to 20% cheap currencies. That's a lot of room for, if the pendulum swings the other way, for international to have some outperformance. And here on the next page, here's the entire history. It's a 54-year calendar year history of comparing EFI returns to US returns. That's 54 outcomes. And if you can see, I wish at this moment I had my laser pointer. Oh, look, you can't see my laser over there. You can see that when the blue lines are going up from that zero horizontal line, then EFI is outperforming. When the red lines are going down from the zero horizontal line, that means that US is outperforming. And over the 54 years that start in 1970, the score is 27 to 27. How many in this room could have possibly guessed that it's even remotely close to that? But it is. And you can see that it goes in multi-year swings. And we've just had I think it's something like 10 out of the last 12 calendar periods you've had, 9 out of the last 12, something like that. You can see there's only 3 red lines going up. That US is outperformed by a big amount. Again, so today you have US with expensive valuations in an expensive currency, or those other currencies are cheap. And as things can get to normalize, so for instance, today, US data came out on inflation that was happily benign, right? And so, again, I mentioned how US inflation has gone from 9 to 3. And if that 3 is the complete measure of inflation. The one that's core was closer to 4. So in that 3-4 range, again, 2 months in a row now, it's been confirmed to be heading down nicely. And so today you're getting stocks up everywhere, internationally and US, dollar down about, when I looked before I came over here, dollar down about 50, 60 basis points today against most currencies. And so, again, I think when you get some normalizing of economic conditions and inflation, interest rates, monetary policy, and fiscal policy, with the cheapness that I've just described, I think you could see, it's very possible that what you saw in the fourth quarter, first quarter, you could get some extended run on that. And so I'm not here to tell you to bet the ranch or, go in a big overweight way toward international. I'm just saying, stay strategic, don't give up on the asset class. It has started to pay you, and I think the fundamentals would say it can continue to pay you. I want to respect your time. We have about 2 more minutes. So again, I think economic market conditions are getting to be much more favorable for both making money, making positive double digits so far this year returns, and for our style of management to outperform. I know there's a normalization of monetary and fiscal policy heading in that direction. And then international, the asset class is cheap, stocks and currencies, and with normalizing, you could get some extended outperformance, I think, from international as a sea change from what happened the last 10, 12 years. Question, comments?
Do you have hard copies of this?
Do
you have hard copies of this presentation? Okay, thank you.
Yes, we have a whole bunch of paper copies. We have about 20 of them, right? Yes. Other questions, comments?
Any other questions, comments? Okay. Well, thank you very much.
Thank you very much.
Great presentation. Okay. Item number 4 on the agenda is the consent docket. We can take that with one motion. Have a motion and a second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. Have a motion and a second. Record your vote. Item is approved. Okay. Item number 6 is to approve the claims docket. Having a motion and a second. Please record your vote. Item is approved. Item number 7 is to approve the following applications for service retirement. Have a motion and a second. Please record your vote. Item is approved. Item number 8, receive report of death, authorize payment of the $5,000 death benefit. We have a motion and a second. Please record your vote. Item is approved. Item number 9 is to receive report of death, authorize payment of the $5,000 death benefit. Have a motion and a second. Please record your vote. Item is approved. Item 10 is to approve the following applications of vested rights. We have a motion and a second. Please record your vote. Item is approved. Item number 11 is items for individual consideration. Item 11A is purchase of record storage and scan on-demand services from Midcon Data Services. Any questions? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. Item number 12 is to receive the investment consultant report.
Okay, good morning again. Regina, I am going to talk about the quarter report. If you go to page 20 in the quarter report, and then I'm going to reference the piece that I handed out just to touch on some numbers here as we look at performance. When we drill down on performance, you're going to see your relative performance relative to the policy index over the one-year period trails a bit, and relative to peers trails a bit. And the reason why I put this supplemental piece together is really to try to take out some of the noise and look at longer-term time horizons, 3 and 5 years over rolling periods, because as you heard from Lazard, the last couple of years, you have a question? Or
No, I'm good.
The last couple of years, we've had some significant extremes, beginning with the downturn in the market with COVID, massive stimulus that really rose a lot of equities, some lower quality, particularly in the growth space, and then beginning in 2022, a massive effort to reduce inflation by increasing interest rates. In your policy index, what we're measuring your total portfolio against, you're not implementing in lockstep with that. We're doing some things that we expect over time to add some incremental value and also to mitigate risk, particularly the private market strategies, private equity, real estate, and hedge funds to a degree. So the S&P 500 is 28% of your policy index. The MSCI ACWI, which is another global equity index, is 10, and then the EFI index is 11, and small cap or Russell 2000 is 10% as well. That S&P 500 at 28% and the ACWI at 10% represents your 18% allocation to large cap. So your target allocation to large cap is 18%, a lot less than what's in that policy index, because the private equity is also, we're measuring it longer term. We expect to get a premium return to public markets, but in the short term, we know there's going to be deviations. And you'll see right now, over the last year, private equity is slightly negative, and the S&P 500 is up 13%. So that's causing a lot of dispersion there. Same with the hedge funds are up 8% over the last year. We're measuring that against ACWI, which is up 13%. And we don't expect them to be up as much. But over time, they're going to reduce risk, and I'll show you that in a minute here. This page, I'd just like to talk about dollars. So as we look at the last 3 years, this goes really to March of 2020, so the bottom, a quarter after the COVID bottom. You began that quarter at $757 million. Net additions, which is cash flows for operations, less contributions in, so negative just slightly under 100 million in outflows at 93 million. The portfolio has grown 173 million since July of 2020. If we took that back another quarter, that's probably about another 30 million the quarter before, if you looked at the end of March of 2020. So at the end of June of this year, he stood at 837.6 million. If you go to the next page, this is a very black and white yes or no page looking at your risk and return results over longer time frames. And this is really how we should be looking at it for a pension fund where your assets are allocated in an effort to meet your long-term liabilities. So we know we got to take market risk. We know we need at this time a 7% rate of return over the longer time horizon, and we want to do that with a prudent amount of risk. This portfolio has been designed with risk mitigation in mind. We know we have to take equity market risk, but we're trying to do it in a way that we protect in the downside and participate when markets go up. And if we look over the 10-year period, the first two measures there are return metrics. The first being your actuarial hurdle rate, 7% today, and the second being a policy benchmark, what the actual asset allocation would suggest. Over a 10-year period, outperforming on both of those. Over the most recent 5 years, we're trailing a little bit by the hurdle rate by about 40 basis points and the policy index by 2 basis points, so basically in line. On the risk metrics, we're coming in below on all of those, which is what we would expect with how this portfolio is allocated. So standard deviation or volatility, you have less volatility than the policy index would suggest, and that's because we're doing some things a little bit differently. The hedge fund allocation, the private equity allocation, and then just managers in general. Nature of how your managers, your public market managers, as well as your fixed income managers allocate to generally higher quality, we tend to be a little bit lower volatility. The next measure is a measure of sensitivity to the direction of the market, or beta, and this portfolio comes in a little bit less sensitive. So what that means is when we're going up, we might not be up as much. When we're coming down, we shouldn't be down as much. And that last metric is an indication of that down capture. So what that's representing is when markets are down or the policy index is down, represented by your target allocation, how much of that are you capturing? So over the 10-year period, if the broad market or policy index was down 10%, your portfolio has been down 9.1%, so you're down less. So we're meeting those risk metrics. If we go to the next page, yep.
As the new guy here, can you help me understand the difference between actuarial rate of return and the annualized total return and why they're different?
You mean what you're seeing here on this page, or what
well,
the actuary uses?
yeah, the benchmark 7% for actuarial rate of return, and it's 6.59 for annualized total. So why would those benchmarks be different, or what would
The
drive
annualized, that second bullet, that's the policy index.
Okay.
So that's what the actual asset allocation, if you were 100% passive in the weightings that we have in your asset allocation, that's what that would have returned.
Okay.
The first metric there, that's just a absolute rate of return. So
Gotcha,
we
okay.
need, your actuarial rate of return objective is 7%.
Yeah, so 7's what we need to achieve our promised benefits. The second one is what we would expect
Right.
based on our investment allocations.
Correct.
Okay, thank
Yeah.
you. Yeah.
Keep going a couple pages forward, right here, okay. So as we look at this page, on the right side, we're showing the total portfolio. This is all ending June of 2023. So it's one time period or one endpoint. And you'll see actually for the year to date, so for the first 6 months, the absolute return of the portfolio for half a year, 6.8%, that's pretty strong. If you did that in the second half of the year, you'd be getting a 13.6% return, which is significantly above what we're anticipating. But as we look at that relative to the policy index, we're a bit behind, about 1.2%, and relative to peers, for that 6-month period, we're in the bottom decile, if you will, relative to peers with a similar equity allocation, and the bottom quartile relative to other public pension funds. So I really wanted to drill down here and just kind of, number one, give some explanation. First of all, that 6.8 is a strong return. When markets are going up, we don't expect to be up as much. Relative to the policy index, it's really the private market strategies. Private equity is being measured in the short term against the S&P 500. Your private equity is flat. You're seeing this year private equity markets, our portfolio is being marked down to catch up with what happened in public markets in 2021. Some of that dispersion is from the hedge fund side as well. You're up 8.6% in your long-short equity allocation. That's being measured against a long-only benchmark that's not hedging, that's up about 13%. Relative to peers, it's a little bit different story, and we had to drill down on this earlier this week as we look at the peer group we're using, and this is a collection of data that is aggregated by Investment Metrics, which is our data provider, looking at other public pension funds across the country, and it's a pretty robust database. The biggest issue relative to peers right now is allocation to private equity and allocation to real estate. The median allocation to real estate within this peer group, and this is looking at public funds and other funds 55 to 70% in equity that are much smaller than you and some that are larger, but I think it's really being influenced by the smaller funds. The median allocation to real estate is about 5%, where your target is 15, you're a little bit below that. Having less real estate this year, when real estate is down, that's having an impact relative to peers. If we look out further over time, you look at the 3, 5, and 10-year periods ending this quarter, we're in the ballpark relative to our policy index and relative to peers. What I wanted to show you is to try to take out some of this noise, is this handout that I just put together. Because oftentimes we get lost when we're looking at endpoint specific, and sometimes I hear questions, well, I look at every period and we're trailing the benchmark or trailing the peers. Well, this is one period, one endpoint right now, looking at different time horizons. If you go to page 3 in this piece, and I'm sorry if there's folks, I've got a couple. What we're doing here, and I'm sorry, didn't send this in advance, so we just have the hard copy, is looking at rolling 3-year returns on a quarterly basis. So we went all the way back to March of 2019, looking at every quarter, looking back 3 years, what the return of the portfolio was relative to the policy index and these the peer group, and where you ranked in that peer group. So the table, you can look at the bar charts, and really it's just this quarter where your total return is still above your actuarial rate of return of 7 on a 3-year basis. We're behind the policy index. We're a little bit behind the median peer and ranking in the 61st percentile. If you go back every quarter, looking back 3 years, you'll see that on average, going back to March of 2019, which I think is 16 quarters, your portfolio average 3-year return is just under 9% at 8.97%. The policy index return is averaged about 8.23%. So on average, we've been pretty significantly ahead of that. And relative to the peer group ranking, this portfolio's average 3-year peer group ranking is 29th percentile. So this is trying to take out some of that noise. We know in the short term we're doing some things a little bit differently, and we're going to have some deviations relative to some of these broad metrics, but over time you're really I think this nicely shows how that's taking out some of that noise and why we focus on longer-term time periods. The next page just looks at rolling 5-year periods doing the same thing on a quarterly basis. Similar story. If you go all the way out to the right over those 16 or so quarters, the average 5-year return is 7.95%, a little bit less than the 3-year, and I think it's because we're going back a little further and capturing a period that wasn't as strong, but still relative to the policy index, about 60 basis points of outperformance, and relative to peers, on average, your 5-year peer group ranking is above the top third. So I thought this was useful just to try to take out some of the noise. We know in the short term there's things going on. We're doing things a little bit differently. The expectation over time, particularly for these private market strategies, when I say broadly speaking, I'm not just talking about private equity, I'm talking about the hedge strategies, and I'm talking about real estate that don't track public market benchmarks closely. The purpose for private equity is to provide a premium return over time to the S&P 500. If we look at the 10-year return for your private equity portfolio, as of the end of July, it's 15.5% relative to the S&P 500, which is 12.6%. So you're getting that premium return over time. Long-short equity is designed to provide similar returns to equity, but really provide protection in down markets. And historically, it's done that and that's why you have less. You'll see here in all these volatility, the standard deviation here of your portfolio, you go down here relative to the policy and relative to peers over all time periods, you have a lower standard deviation, lower beta, lower down capture. And then real estate.
Hey, Jason?
Yep.
I was going to ask you on the rankings on this thing, what's 92 out of 77?
On this page,
What does that mean?
that's the 92nd percentile for the 6-month period,
Okay.
meaning
What's
92% outperformed. It's low. It's on the low end of the peer group ranking.
What's 77 mean?
Well, there's two different peer groups. So the 92 is versus funds 55 to 70% in equity. So it could be
Okay.
any type of investor. That could be endowments, foundations, corporations.
Okay.
That it's just an equity risk target, and that's a pretty wide range. The 77 is relative to public pension funds. So for the 6-month period in the 77th percentile. On the piece I handed out, this piece, this is just the public, we're just showing the public DB. They generally run fairly close. But you'll see that on the 5-year basis, your ranking versus public DBs has averaged in about the top third. And on a 3-year rolling basis, every quarter, you're averaging in the top 29 percentile. So that's that quarter, or that 6-month period, that year to date. Any questions on that? I mean, that's a lot of detail on relative performance metrics, but a lot of times when I see numbers like this, I want to drill down and hopefully help understand what's going on better. We don't think anything is broken. We know what we're doing we're not tracking, we're not implementing in a way that's going to track these public market benchmarks precisely on a quarter-over-quarter basis. Over time, we're trying to get more return with less risk than your policy index would suggest and relative to peers. You don't have to go to the ASAP, but I'll just mention a couple things. You're currently a little overweight to your reduced target to long-short equity. We reduced that to 5% earlier this year. The August ASAP still shows 8.3%. There was a redemption that came in after the first of the month for $10 million. You also got the third tranche of redemption from the Morgan Stanley Prime Property Fund in the month of August. Actually, no, that was in June, and Matt left. It's still sitting in that real estate account, which was about $2 million. So you made a $15 million redemption from the Morgan Stanley Prime Property Fund in December of last year, as you'll recall, because real estate did well. It wasn't marked down, so your real estate was above target, where equities and fixed income was down, so we put in a redemption. One of the things I had mentioned is that, that there's a queue to get out of that real estate fund. They don't just sell buildings to provide liquidity to investors, because that would create obviously greater issues in the fund. So they do a managed liquidity process. You're about 60% of your redemption has been fulfilled. There's another 40% remaining, so there'll be a little bit more coming at the end of September. I think you're now underweight to real estate. So we'll look at this at the end of, once that third quarter redemption comes back, and more than likely, we may be recommending that you rescind the balance of that redemption. You won't need to get that money back, because the portfolio has rebalanced itself, some of which money coming out and some of which real estate marks coming down and equity and fixed income going up. We think with those redemptions that have already come in cash, you don't need to raise any additional cash, at least not for this quarter. And we've talked to Regina and Matt about that. Any other questions on the portfolio?
Any questions for Jason? Thank you, sir.
Thank you.
What? Oh, Chair needs a motion to receive both the reports on item 12. I have a motion and a second. Please record your vote. Item is approved. No? Item approved. Okay. And item number 13 is comments from board, staff, and citizens. Anyone that's planning on going to the conference end of next month? I know when I made my room reservation a couple weeks ago, they were getting few and far between. So if you're planning on going, you haven't made your room reservation yet, you better get on it. So, anything else? Okay. We are adjourned at 10:53. Thank you, everyone.